In July 1974, Elena Markovic stood at the checkout counter of a small grocery store in Belgrade with a list of groceries for the week. She was a 43-year-old accountant at a textile factory, living with her husband and 2 children in a communal apartment that had taken them nearly 10 years to settle into. A year earlier, Elena had believed herself to be disciplined, thrifty, and wise enough never to be swept away by economic fluctuations. She didn't speculate. She didn't borrow recklessly. She didn't chase asset bubbles. Each month, a portion of her salary was carefully set aside, with the simple belief that saving was a slow but sure way to protect her family. But that morning, when the shopkeeper wrote down the prices of flour, cooking oil, and soap right in front of her, Elena began to understand something far more terrifying than unemployment or bankruptcy. Her money was still in her savings account. No one had broken into her house. No officials came knocking on the door to seize property. Yet, in a short time, what her family could afford had visibly dwindled. Money didn't disappear. It just lost its weight. A few months later, Elena's savings, accumulated over many years, were no longer enough to cover expenses she had previously considered normal. Her story is not a unique personal tragedy, but a very typical example of a larger rule in monetary history: people's wealth is rarely taken away by noisy means. Most of the time, it is eroded silently, through seemingly technical, legal, and even presented changes intended to save the economy. That is the most frightening aspect of any financial cycle. When people think the greatest threat to their wealth is job loss, war, or a banking crisis, the system often operates in a far more subtle way. It doesn't need to break down doors to seize assets. It simply requires a change in the value of money, the rules of credit, and what society calls stability. And once that process begins, what is taken away is not just money in people's pockets, but also their real ownership of the fruits of their labor. What happened to Elena is not an isolated event in economic history. If you compare that story to dozens of other currency crises around the world, from post-war Europe to modern economies, you'll notice a very clear recurring pattern. When the financial system begins to feel pressure from public debt, recession, or major economic imbalances, governments rarely choose the direct path of seizing people's assets. Instead, they use far more sophisticated tools. These tools are often presented as solutions to stabilize markets, rescue the banking system, or protect economic growth. But if observed over a longer period, they have a different effect: they gradually erode the value of society's assets. The first, and most classic, mechanism in monetary history is inflation. Inflation is often described in economic news as a phenomenon of rising prices for goods and services. When the prices of food, energy, or housing increase, it's said that the economy is experiencing inflationary pressure. But this description only sees the surface of the problem. At a deeper level of the monetary system, inflation is essentially a decline in the purchasing power of money. And when the purchasing power of money decreases, it means that savings accumulated over the past begin to lose their real value. Imagine a family saving $100,000 after many years of work. That amount remains unchanged in their bank account. But if the prices of housing, food, education, and energy double within a decade, the real purchasing power of that money is halved. No one comes to take their money. No foreclosure order is issued. But their real assets have been significantly reduced. In financial history, many economists have called this phenomenon an inflation tax, a tax not codified in tax law but having the same effect. As the government expands the money supply to finance spending, the value of the currency circulating in society begins to decrease. And that devaluation is distributed throughout the economy. Those holding cash or savings are often the most visibly affected group. This is because their assets are held in the form of currency whose value is depreciating. Meanwhile, those holding assets that appreciate with inflation such as real estate, commodities, or stocks are generally less affected. The result is a process of asset displacement. Not through confiscation, but through a subtle shift in purchasing power. In many periods of history, this process lasted for years before society realized what was really happening. When prices rise in small increments, many people consider it just normal market fluctuations. But looking back after a decade, they realize their savings are no longer enough to buy what they could have bought before. That's when the real impact of inflation begins to become apparent. But inflation is only the first step. Because as the monetary system moves deeper into imbalance, another tool of economic policy often emerges, and this tool is even more sophisticated. That tool often appears very quietly in financial news. It doesn't evoke the same sense of danger as inflation, and at times it's even lauded as a necessary policy to save the economy. That is sustained low interest rates. After every major financial crisis, central banks typically lower interest rates to very low levels to stimulate the economy. The reasoning sounds logical. When interest rates fall, businesses can borrow more cheaply for investment, people can borrow money to buy houses or consume, and financial markets have more liquidity to recover. But behind this seemingly positive policy lies a very special mechanism of the monetary system. When nominal interest rates fall below the inflation rate, the economy enters a state that economists call negative real interest rates. This means that bank deposits still earn interest, but the real value of that money gradually decreases over time. Imagine a saver receiving 2% interest per year. If inflation is 5% during the same period, they are actually losing about 3% of their purchasing power each year. Their account still grows in numbers, but what that money can buy is decreasing. Historically, negative real interest rates often occur during periods when governments need to reduce their public debt burden. When inflation exceeds interest rates, the real value of debt in the economy begins to erode. This helps countries with high debt levels gradually reduce their financial pressure over time. But the other side of this process is that savers in society bear a portion of the cost. Families who deposit money in banks, retirees who rely on savings, or long-term savings funds all see their assets lose purchasing power. No taxes are levied. No confiscation laws are enacted. But asset shifts continue year after year. And when low interest rates persist for many years, their impact can completely alter society's financial behavior. People begin to realize that holding cash or saving is no longer an effective way to protect their assets. They are forced to seek other assets that are likely to appreciate faster than inflation. Money begins to flow strongly into real estate, the stock market, or riskier assets. This creates a chain reaction in the economy. Asset prices rise rapidly. Financial bubbles begin to form. And the wealth gap between different groups in society widens. Those who own assets that appreciate with the monetary cycle tend to become wealthier. Meanwhile, those who rely on traditional wages and savings fall behind. But when the financial system enters a more strained phase, the government often needs more resources to keep the state running. And that's when another familiar tool of every economy begins to be adjusted. That is taxation. In most countries, taxes are always seen as the official tool for the state to finance its operations. People go to work, businesses generate profits, and a portion of that income goes into the budget to fund infrastructure, public services, defense, or education. In a normal economic state, the tax system usually changes very slowly. Major adjustments typically involve political debate, parliamentary approval, and social scrutiny. But when a country enters a period of financial difficulty, especially when public debt rises rapidly or budget deficits begin to appear, the story often changes. Historically, many governments have not raised taxes with abrupt decisions. Instead, they have adjusted the tax system in less conspicuous ways. Some taxes have been expanded in scope. Some tax thresholds have been adjusted more slowly than the rate of inflation. And some new fees have appeared under different names. Over time, these small changes can have a very large impact. For example, when inflation rises but the income tax threshold isn't adjusted accordingly, many workers may be pushed into higher tax brackets even though their real income hasn't increased. This phenomenon in economics is often called inflationary tax slippage. On paper, the tax rate may remain unchanged, but the real amount people pay increases. Another mechanism that often emerges during difficult budgetary periods is the expansion of consumption taxes. When taxes are shifted to goods and services, the financial burden spreads throughout society through prices. Consumers may not immediately realize they are paying more taxes. They only see the cost of living gradually increase over time. But when viewed from a long-term perspective, this shift can move a large amount of wealth from the household sector to the state budget. In financial history, many countries have used a combination of tax and monetary policies to manage periods of large public debt. Inflation erodes the real value of money. Negative real interest rates reduce the purchasing power of savings. And the tax system regulates the flow of society's money into the budget. When these three factors work together in an economic cycle, they can create a very powerful flow of assets. But sometimes, those tools are not enough to keep the financial system stable. Because when a crisis occurs at the systemic level, when large banks are on the verge of collapse or credit markets freeze, the government often has to resort to a much stronger measure. A measure that has become familiar to the financial world in recent decades. That is rescuing the banking system and financial markets. When the financial system is in peril, major decisions are often made quickly. A large bank faces the risk of bankruptcy. The credit market suddenly freezes. Financial institutions no longer trust each other enough to lend overnight. In such times, the government often faces an extremely difficult choice. If the system is allowed to collapse on its own, the consequences can spread throughout the entire economy. Businesses lose capital, the job market weakens, and public confidence in the financial system may completely collapse. But if intervention is too drastic, the state will incur enormous costs. In most major financial crises of modern history, the ultimate choice has usually been to rescue the system. Central banks inject liquidity into the market. Governments provide massive support packages to keep large financial institutions afloat. These programs are often presented as a necessary measure to avoid a deeper crisis. And to a certain extent, that is true. When a financial system completely collapses, its impact can damage the entire economy. But what is less discussed is where the cost of those bailout programs ultimately goes. The money to rescue the system doesn't usually come from a single fund. It comes from the state budget, from issuing more public debt, or from expanding the money supply in the economy. This means the ultimate cost is distributed across society in various ways. When the government issues more debt to rescue the financial system, that debt burden is paid off over the years through taxes or through a decline in the purchasing power of the currency. When the central bank expands the money supply to support the market, inflation can rise and reduce the real value of savings. In both cases, the cost of the crisis lies not only with the financial institutions that initially created the risk. It spreads throughout the entire economy. That's why many economic researchers often describe financial bailouts as a process of risk socialization. When the market is booming, profits are concentrated in financial institutions and large investors. But when the system is in crisis, the cost of stabilizing the market is often distributed across society. This process isn't always immediately apparent. In many cases, its impact only becomes clear years later, when people realize that the cost of living has increased, taxes are higher, or the value of the currency has decreased. But in deeper crises of the financial system, sometimes even bailouts are not enough to stop the outflow of money from the economy. When confidence in the system begins to waver, people and investors often seek to move their assets out of what they perceive as risky areas. And it was during those times that another tool of economic policy began to emerge. That was capital control. When confidence in the financial system begins to waver, money flows often react very quickly. Those with large assets seek to move money to more stable countries. Investors withdraw capital from domestic markets. People seek to exchange their money for foreign currencies or other assets they believe are safer. In a globalized economy, money can move in seconds. And when a large amount of capital leaves the system in a short period, it can create immense pressure on the currency, the banking system, and the entire economy. Therefore, during many financial crises throughout history, some governments have chosen to use a very powerful tool, capital controls. These measures can take many forms. Some countries limit the amount of money people can transfer abroad. Some impose limits on bank withdrawals. Others control the purchase of foreign currency or require large transactions to be approved. On the surface, these policies are often interpreted as emergency measures to stabilize the market. When money leaves the system too quickly, temporarily restricting capital flows can help prevent a deeper currency crisis. But from the perspective of people's assets, these measures also have a very clear consequence. Their assets are trapped within the domestic financial system. When the ability to move money out is restricted, people have fewer options to protect their assets against inflation, currency devaluation, or major economic fluctuations. Historically, many countries have implemented capital controls during periods of deep crisis. These measures sometimes lasted only a few months, but in some cases, they lasted for years. During that time, the asset structure of the economy can change significantly. Money flows are trapped within the domestic system. Domestic asset markets are highly volatile, and people's ability to protect their assets is becoming more limited. But even when capital flows are controlled, the financial system still faces another problem. Each major crisis typically leaves behind a massive amount of debt, government debt, bank debt, and corporate debt. To deal with that debt, many countries are forced to readjust the legal structure of their financial systems. And it is during this period that another tool of the state often emerges. That is, changing the rules of the game in the financial system. When a financial crisis passes, what often follows is not only a market recovery, but also a wave of changes in the rules of the financial system. New laws are enacted. Banking regulations are adjusted. Capital, liquidity, and risk control standards are rewritten. On the surface, these changes are often interpreted as an attempt to prevent the next crisis. And in many cases, that is entirely true. After every major systemic shock, policymakers always try to build new safeguards to protect the economy. But financial law doesn't just shape how banks operate. It also shapes how society's assets are stored, managed, and moved. As regulations change, the flow of money changes as well. A classic example from history is how governments regulate pension systems and long-term savings funds. In many countries, these funds hold vast amounts of people's assets. When the investment laws of these funds change, trillions of dollars can be redirected into specific asset classes such as government bonds or state-sponsored projects. This means that people's assets, even if still registered in their names, can be steered in directions that serve the state's financial stability goals. Another mechanism that often emerges during crises is the alteration of banking system rules in the event of bankruptcy. In the past, when a bank failed, the government typically had to use taxpayer money to bail it out. But in recent decades, many countries have incorporated a new mechanism into their laws. Under this mechanism, when a large bank faces bankruptcy, a portion of the losses can be transferred to large depositors or investors in that bank. Such legal changes are often presented as a way to reduce the burden on the state budget. But they also simultaneously change how risk is allocated within the financial system. When the rules of the game change, so does how assets are protected within the system. In monetary history, periods when financial laws are rewritten often mark a major turning point in the economic cycle. Because from that point on, the structure of the system is no longer the same. Money flows under new rules. Financial institutions operate in a new legal environment. And people must adapt to a changed asset system. When all the elements that have emerged throughout this story are put together, inflation, negative real interest rates, an expanding tax system, financial bailouts, capital controls, and changes in financial law, they form a very clear picture of how monetary systems operate during periods of stress. Assets don't need to be confiscated to move. It just takes the rules of the system to change. And when those rules change for long enough, the wealth structure of society as a whole will change as well. But the most remarkable thing in monetary history isn't the existence of these mechanisms. What's remarkable is that they often appear together in the later stages of a major financial cycle. When economic historians look back at the final stages of major monetary cycles, they often don't just look at a single policy. They look at how many different factors come together and begin to interact. Inflation gradually erodes the purchasing power of money. Negative real interest rates alter society's saving behavior. The tax system expands to compensate for increasingly strained budgets. Financial bailouts appear when the banking system faces risks. Capital flows are controlled when confidence begins to waver. And financial laws are rewritten to keep the system's structure intact. Each individual policy can be explained by rational reasons. Stabilizing the economy. Protecting the banking system. Maintaining growth and employment. But when all those mechanisms emerge in the same historical period, they create a far greater effect than each policy individually. They change how wealth is allocated throughout the economy. Those who hold assets capable of adapting to the new monetary cycle often retain their value. Meanwhile, those who rely entirely on cash, fixed wages, or traditional savings often see their purchasing power diminish over time. That is how wealth has moved through many of history's financial cycles. Not by a single, clear decision to seize, but by slow changes in policy, in laws, and in the value of money. And as that process unfolds over many years, society begins to realize that the rules of the system have changed. The familiar paths of wealth accumulation of previous generations no longer work the old way. Markets once considered stable become more volatile. And new asset classes begin to attract the attention of global capital flows. In monetary history, such periods often mark a turning point in the financial cycle. An old cycle gradually closes, and a new cycle begins to form. In that new cycle, market rules may change. New technologies may reshape the economy. And new ways of storing value may emerge to replace what was once considered stable. But no matter how the form of the monetary system changes, one lesson always repeats itself throughout history. Those who understand how financial cycles operate are often better able to adapt to the changes of the times. They realize that money is not just a tool for exchanging goods. It is part of the economic power structure, where policy, credit, and assets are always closely intertwined. And when that structure changes, the way wealth is created and protected must change as well. Perhaps that is the most important lesson monetary history has to offer. Not all crises are the same. Not all financial cycles repeat themselves in the same way. But the way monetary systems adapt to crises almost always follows familiar patterns. And by understanding those patterns, we can see more clearly what is happening around us, not just in the past, but in the present and the future.